Welcome, student, to this class of security analysis topic. I see Ashish Gupta, Joint Director Board of Studies, welcomes you all. Student, in the last class, we have seen that how the security and we carry out the security analysis. Now, in the earlier class, we have covered fundamental analysis. Then there is another part is technical analysis. Of course, we have started with the two theories, that is the Dow Jones theory and which is also called Dow theory and Elliott wave theory. Now, today in today's class, we shall complete this topic. However, if we talk about this technical analysis, it is a very vast topic. Okay, and we can say that because it is basically depend on our perceptions, assumptions, etc., and it varies from person to person. However, the scope of coverage is limited in our syllabus. So whatever important things that is a part of our syllabus, I will cover today. And now, student, we have also supplied you an assignment, and today's we shall discuss these assignment questions in the class as well. So, student, let us start our discussion. One second, I just share my screen. In the earlier class, we have covered our this much portion. That is, we have started with the let me tell you, industry analysis. We have carried out everything we have carried and discussed. Okay, now let us move to our next topic. That is technical analysis. All these we have covered. Okay, now we are coming to the technical analysis portion. Okay, we have covered Dow theory. Of course, it is a one other part of theory. Okay, now we have also covered our, this is Elliott wave theory. Okay, now when I talk about technical analysis, broadly, I can say that we can divide our technical analysis in three parts. Okay, now I'm just presenting you by that way of table. Of course, the theoretical portion is covered in the study material. You can refer it from there. Okay, now one part is price and volume chart. Okay, then another portion is analyzing the price patterns. Okay, then another is tools and indicators. Okay, the purpose is same, just to, because technical analysis is, we can say that, where the fundamental analysis let us know where to invest. Technical analysis let us know when to invest. Okay, it is more concerned with the technical. We can say that it is more concerned with the timings. Okay, I just write it again. Tools and indicators. Okay, now first start, that is bar chart. Okay, then it is a line chart. Okay, then it is a point and figure chart. Its numerical is today we shall discuss. And then there is a candlestick chart. Okay, now let us see whether there is any other chart is available. Because it is in your study material, it is as per your study material. Okay, yes, 4 charts we have covered. Okay, now next is comes the price patterns. Okay, so generally it covers channels. Okay, it covers wedge. It covers head and shoulders. It covers triangle and coil formation. Then it covers flags and pennants. Then it covers double top. And then it covers double bottom. One second, I think I will double bottom form. And last it covers gap. Okay, then we go for the indicators. Okay, basically tools and indicators are generally in a mathematical terms. More they are in the mathematical terms. Whereas these things are mainly chart form. These are somewhat we can say tools and indicators are in mathematical form. These are mathematical computations. Okay. And any other, I think, moving average. And there is one RSI, retails relative strength index. And there is one more, I can say that relative strength index. Okay. Yes. There is then breadth index. Okay. These are mainly relating to the market volume of transactions. Okay. Then it is a confidence index. Then it is RSI I have covered. It is both, and then it is a odd lot theory. So broadly, these are somewhat we can say that these are kind of a mathematical expression. These are generally used for in what direction the market is going. So tools we understand, and from this mathematical analysis we take our decisions. So when we talk about technical analysis, we have covered Dow theory. Okay, now let us move further. One second. As a theory, we have covered charting them. Now, first we takes a line chart. Then we will take bar chart. Then we shall discuss Japanese candlestick chart, and then point and figure chart. Okay, student. Now let us start with the line chart. Basically, line chart is nothing. It is simply the presentation of prices. Okay, I'm just writing draft roughly. Okay, no problem. It is just we either here the time or day are mentioned. Here the prices are given. Please note that student, generally closing prices are used for this charting techniques. Generally, there are four type of prices that we shall discuss when we shall take Japanese candlestick chart. But normally, in a simple line chart, say on day one, our prices is this much. On day two, the prices are this much. On day three, the prices are this much. Okay, and on day four, the prices are this much. So accordingly, which is just join the lines. Okay, it is just a simple line chart. Okay. On the other hand, the bar chart is basically presentation of prices in the form of bar. Same prices are in the form of bar. Okay. The most interesting part is Japanese candle stick chart. Okay. Now I show you how this Japanese candle works. One second. I think it is taking some time. Now, generally, it is same here the day or timings. Okay, here the price. Generally, these are candle. These are used for made for one day separately. Say it is a 1, 2, 3, 4, 5. These are our trading days. Okay, on each day, what we do, we draw the candle like this. We observe the four prices. That is highest price of the day. Okay, then lowest price of the day. Then opening price, then closing price. These four prices are shall be covered here. Okay, so when we talk about opening price, say somewhat our price open at this level. Okay, so at this price level open, okay, it goes say high to at this point. Okay, even during the day, it has gone lower up to this point. Okay, but it has closed to somewhat we can say at this point. So we write it here is close price, open price. Okay, we draw the line. So that's why it looks like a candle. Okay, we join these dots and this. Okay, so it is the highest price. It is the lowest price. Okay, now question comes. Suppose it may be possible that this position may be reversed. That is, opening may be at a higher price, and during the day closing price has gone down. We can say that in the given case, in the opening was at a lower price, but close was at a higher price. So it may be also reverse way, that is opening at a higher price and closing at a lower price. So in that case, what we do, I'm just going by saying another. I'm just since a days left is less, I am just considering another day. Same way, suppose it is I say it is a day 2. I just write it. Assume that it is a day 2. Okay. So what say on a day 2, our opening prices were high and closing prices were less. Say our opening price somewhat nearby this. Okay. And closing price somewhat nearby this. Okay. This was our highest price and this was our lowest price. So we again join the dots. Okay. Here it is the opening price. Here it is the close price. It is the highest price. It is the lowest price. Now question comes, how we can differentiate between these two positions, that opening was at a lower price and closing was at a higher price. Here opening was at a higher price and closing was this. For this, what we do, we darken this candle. Okay, when the candles is darkened, it means the opening was a higher price and closing was at a lower price. So by this we can analyze the trend. Okay, by this we can analyze the prices, that where in what direction they are moving. Okay, so this was our second chart, that is Japanese candlestick chart. Okay, now when we talk about point and figure chart, it is very interesting. Say I will just put a one possible. Or I do one thing. One second. I just check out if I just do one thing. I just go for other file where I can show you. Now, how it works, let us see. Now, student, in this case, what happens? Here we write the prices. Okay, so they say our price is here 25, 26, 27, 28, 29, 30, 31, 32. Similarly, here this 23. Okay, now in this case, say, because there is one question as well. Of course, at the time of question, I will make you more understand. So here, these are we on the top, we write as a days. Here the days are given. Here the prices are given. Okay. Now see what happens. If there is a price rise, say today the price is 24. Okay, we start with the 24. Okay, in the day, price goes this. Okay, 27. I think it is now you leave it day right now, you remove it because in the day it will change. Okay, now price say goes up to 28. Okay, generally for the increase, not generally, rather than we it is used conventionally for increase, we show the cross sign. Okay, now suppose market starts with the stock market price start with the 24, it goes up to 28. After 28, say it comes down to 26. Okay, so what we do, we place 0, 0. Okay, it indicates that price has come down to 26. If it goes further down, we add more zeros. Now again, suppose from 23, price moves come to the 25. So we add it by this. Okay, please remember student, always very important to note that in a, we have noticed that in the one column only one sign will appear. Okay, it is very important. If we see here only one sign, that is zero sign or cross sign, one sign will appear only in one column. No mixing is allowed. Okay, so this is called point and flicker chart. Okay, I hope it is clear. More clarity will be given when we shall take one numerical today in today's assignment. Okay, so don't worry that much. Okay, this was our candlestick chart and point figure chart. So it four charts we have covered. Okay, now next we come. One second. Let us see the our 1 second. Now next part we cover our this is our technical sorry, just this one our chart. Now we are these are some like price pattern, channel, wedge, head and shoulders. So let us discuss of one of them. Then we shall move to the tools and indicators. Okay, before first of all, let us discuss the support and resistance level. Support and resistance level, generally, it is the outcome of this. We shall discuss later on. Now, first of all, let us see the interpreting the price patterns. Okay. Now, channel is a series of uniformly changing the tops and bottoms, giving rise to a channel formation. A downward sloping channel would indicate the declining prices, and upward will channel will then. So, somewhat it appears if we go by the diagrams. Now, these all diagrams have been given in the study material. From there, you can get an idea. Okay. Similarly, a wedge is formed when the tops resistance level and both support changes in the opposite direction, that is tops are decreasing, then bottoms are increasing and vice versa. So now let us discuss what is support level and resistance level. Okay, now it says when index or price goes down from the peak becomes the resistance level. See, I tell you what is exactly these two term means. Now whenever we analyze the price, so it what happens, just I show you by way of diagram. Prices move like in somewhat in this direction. Okay, generally it has been observed that the prices move in say in this direction. So what we do, we draw a line here. Okay, roughly we draw a line here. It is generally called the resistance level, and it is called the support level. Okay, resistance means price will not go above this price. Okay, generally we shall observe that price will be move here, here and there. When it goes here, it start declining. Similarly, support level means price will not never goes beyond this point. Okay, it will never go this way. So it will start rising again and again. So this is called resistance and support level. So it says that a wedge is formed when the top resistance level and the bottom level of changes in the opposite direction, that is tops are decreasing, then the bottoms are increasing and vice versa. So it means somewhat now here the direction is straight line. Okay. Now when we draw the same diagram, this diagram, it forms like this. Okay, this is called wedge. Okay, then there is a head and shoulder. It is a dostotic drawing of a human form which large humps on the head and the middle of the two times smaller humps. Now, when we talk about the head and shoulders are generally indicator of a reversal. We can say it can be defined whenever there is a reversal of a long-term trend. Okay, this because it is now I show you what is head and shoulder. Because all these diagrams are in your study material. Okay, please refer, I think, page number 4.24. Okay, head and shoulder. Now, if we say that, now it is has been shown like this. Okay, so we can say that it is somewhat kind of a, it is we can say trend reversal. Okay, so somewhere it is market is going into the bullish phase. Okay, market is going into the bullish phase. We can say that. Okay, similarly, if we, it is also there is a term inverse head and shoulder where the market is going down. Okay, because we can see that this top, this top now it is more than top is again going and again. So it is trying to somewhat going up and up. Okay. Similarly, when we talk about inverse, it is also called the inverse head. And here it is somewhat we can say that it is kind of a bearish trend because it is prices more and more going again and again. Okay, so somewhat this is called the head and shoulder formation. Okay, then there is a triangle and coil formation. Triangle and coil formation generally represent, we can say that I just these are generally represent. It is also shown the reversal of the trend. So generally these are, we can say that it shows the reversal of any trend. Okay, so similarly, flag and peanuts are there, double top, okay, double top and double bottom. Okay, similarly by double top it forms the indicates a bearish development, it represents a bullish development. Okay, now if we see the diagram, the study material, okay, double top, double bottom have been given to you on the page number, I think 4.26. Okay, you can refer it from there. Okay, somewhat it looks like, okay, and double bottom somewhat it is somewhat down here. Okay, so it indicates our price range. So these are all here, or anything have been left. Then there is a gap. A gap is a difference between the opening price on the trading day and the closing price of the previous day. The wider the gap, stronger the signal for the continuation of the observed trend. Now, student, please note that as I told you, there are four prices when we are doing this our candlestick chart. Okay, now I again write it here. There are four prices. One is opening. Okay, then highest, then lowest, then closing. This closing price are very important. Why? Generally, what happens? Even in some countries, the index is based on the closing prices of the constituent shares. Okay, I think in India we use normally last half an hour closing prices, half average of something half an hour or 1 hour something closing prices. So in India, generally even in some countries only just closing prices are taken. So generally they are considered to be the more indicative of the market trend. Now what happens in case of a gap? Generally next day opening. Next day opening prices are generally close to this previous day closing prices. Okay, next day opening prices are generally close to the previous day closing prices. So generally it is said that they should be nearby, somewhat very small difference. If this gap is on a higher side, okay, this if this gap is on higher side, then it indicates there is some trend reversal. Okay, there is some sentiments going. It says the continuation, wider the gap, stronger the signal for a continuation of the observed trend. It means suppose I just tell you now if suppose 20, I just assume any date, say 25. One second. On say 25, we are observing the prices of 26, 27, and 28. Somewhat I am just assuming maybe on these days, maybe any holiday, but I am just assuming these 5 days we are with us. Okay. Now say here that day, opening prices somewhat say share of was 50, closing price was say 60. So it indicates some that there is a bullish trend. Okay. Now next day, the opening price say comes to 62. Okay, and the closing price say 75. Okay, so it means there is a bullish trend in the market. On next day, say the prices come say 89. Okay, not sorry, my mistake. It becomes 79. Okay, it becomes a 79. Okay, and in the closing of the day, it say it was say somewhere okay 95. Okay, now next day it comes say 100, 102. Okay, 110. So what does it indicate? Here we see the difference of 2. Here we see the difference of gap of 4. Here we observe the gap of say 7. So what this increasing gap indicates that the market is in bullish trend. Okay, because see what happens when the market is in bullish, we always say that, oh yeah, this closing price was there. Next day morning, I will punch my order for a higher price so that I can get the benefit. So there is a buy and trend. Similarly, it oppositely happen when the market is in a bearish trend. The people start offloading their holdings, and the prices start, since the supply is more supply, and they start booking the loss, so the prices start falling down. Okay, so this is called the gap. Okay, now next are somewhat market indicators. These are generally relating to the market. Of course, they can some like relative strength index can also be used for our stock market, but generally these are indicators for the that indicates the market trend. Okay. Yes, Samanathan.
Sir, I have one question. On the 25th of May, the closing is 60 rupees price. How come the immediately it will goes to 62? The closing balance, closing price will be the opening balance of next days, right?
One second. It is the closing price.
See, closing price is 60. The next day, the opening price is 62. How come the 62 will go? Actually, the closing price of the previous day will be taken as a opening price of the next days, right?
Okay, opening prices. Suppose if the demand is higher. No, I don't know in the practically. I don't know in the market, but if you deal in the as per your version, next day the first dealing will be at a 60 price.
Yes.
It is I don't know because I never deal in market, very frankly. But generally, it is assumed that in, opening means generally, of course, we are doing the first dealing at this, but next dealing will be at 60 or it will be different.
Yeah, that's okay, sir. But whenever there is a starting price will be the 60, right? The next day opening.
Okay. As per this logic that is having given study material, it means it means the any other price, opening price other than your closing price. We will assume it. Okay, practically I don't know. It is a because I don't know if it happens. I don't know very frankly because I never deal in the market. So even but suppose if you have quoted you give you maybe I am just giving I'm going further little bit further. Now suppose as your closing price may not be the opening price. Hardik Dave is saying sir closing price may not be the opening price. Yes, Hardik, it may be there. I don't know because my only presumption is that say Samanathan, if I just share with you. Suppose you are I am bullish on the market. Okay, I will buy share at 60. But see, the people like me may have a same sentiments and they also quote the same price. Okay, I will buy the 60. But it may not be possible. It may be possible that other side the seller may not be available. Now, if you unless and until seller will be available at 60, my question only to you whether the other seller is bound to sell at 60 or not.
Yes, sir.
Then I am the seller. Suppose if you are the seller, you may say, why should I will sell 60? Market is saying somewhat 60, I don't know. I will sell at my 62. Are you getting my point or not?
Sir, the starting price will be 60, but it will increase based on the demand.
Increases. It is quoted at 60, no problem. But first dealing had taken place at 62. Then which price we will presume?
We have to consider 62 only.
And 62, no, that's the only thing. So basically, opening means the first trading price. These prices are trading prices. Okay, quoted price and can be anything. Are you getting it or not? Opening
yes,
prices,
sir.
Opening prices may be 60. It is coming on the screen 60, but there is no one seller. Then of course the buyer will increase the prices.
Okay.
Okay.
But the triggering point is 60.
Triggering point, of course, you have see trading point. My question is at what price it will traded. Opening price will be considered that price as per and generally it is used. Okay, if first trading is done at 62, it will be considered as opening price. Of course, on the trading stock exchange, it may be coming as a 60, but first entry has been come at 62. Then I don't know. Okay, anyway, it is a long going discussion.
Okay.
We have
Right,
to go by
sir.
the theory. Okay, we have to write in the exam. We have what we have written in the study material. Okay.
Right, sir. Fine, sir.
Okay. Now, when we say this is okay, closing price. Okay, so now when we were discussing about indicators. Okay, now these are some market indicators that gives the market indication. Okay, and what are the first is indicator? Breadth in the index. It is computed by dividing the net advances and decline in the market by number of issues traded. The breadth index either support or contradicts the movement of the Dow Jones average. Actually, this is a more, we can say, computational based. It is somewhere require a lot of calculations. So generally in the market, we analyze what are major advance. See, in a market, there are some securities that have been in prices have been increased. Okay, there may be some prices securities whose prices have down. Okay, so we what we do, we generally we do like this. I just show you. Number we here write like this: number of advances, securities number of advances, or I just write it here. Okay, I just separately write it here. Okay, number of securities that have been prices have been advances. Okay, these have been declined and no change. There may be some securities whose price not have been changed. So somewhat we can say that prices whose have prices has been increased 100, decline was 20, and 10 was no change. Okay, so accordingly what we do, we deduct these two numbers from here, it comes 70. Okay, so true. Next day, what we do, I'll just show you. 1 second. One second, 1 second. I have written somewhere. One second, 1 second. Just try. Net advances. Okay, so advances decline, no change. Okay, net we say right here. Okay, next day, say these are numbers are somewhat like 120. Okay, here it is 10. No change are 5. Okay, so what we do, we minus this, and it comes 105. Okay, so from this, what we do, we understand the breadth of the market. Okay, how we breadth of the market? Say we deduct this 70 from this, so it comes 35. Okay, similarly, we can say that 160, 15, 3. Okay, so it says 150, 142. Okay, the difference come 37. So it means the market is in bullish phase. So it's somewhat given number of advances and declines from we get some idea about the market. Okay, so this is called net decline. So from this, we understand the use the breadth index. Okay, from this we understand the trend of the market. Okay, then there is a volume of transactions. Volume of transactions is very important because more and more shares are trading. Okay, it gives a clue about the market, how the way. And see what happens. Generally, it has been observed that both in case of bullish and bearish phase, the volumes are on higher side. In a in the buy and market or say bullish market, more and more buyers are there. In a bearish market, more and more sellers are there because they want to offload their holding. Then there is a confidence index. Generally, it is related to our bonds yields, high grade bond yield to low grade bond yield. It is usually, but not always, be the, because it is used in conjunction with, because see what happens. Generally, bond indicators are used in conjunction of other indicators because generally it is always presumed that when a market, uh, we can say that when market somewhere, because bond yield, bond generally, bond behave in a opposite direction. Bond generally behave in the opposite direction to the market. Reason being is that when the market is bearish now, the people start shifting their investment from market to the fixed income securities. And when they start moving that to the fixed income securities, generally the yield start declining there because the demand is more, supply is less. Okay, everyone starts paying some premium. Okay, so it is generally also the, and that has to be used in the indication, and that's why it is called, it is used to be used in the connection with the other indicator. Okay, then it comes the relative strength index. Okay, relative strength index, it says that, suggests that the prices of some securities rise relatively faster in bull market, decline more slowly in the bear market than other securities that exhibit the relative strength. So generally, in case of relative strength index, what we do, we carry out the analysis of some securities. Okay, we carry out the analysis of the some securities, and from this, we came to know that there are some securities whose uh, price. Now, I just show you by way of diagram, just, and even there is a one formula. RS is equal to relative strength means okay. Now average gain, one second. Okay. Now let me show. One second. I throw the more light on this. One second. One second. Okay. One second. I'll just show it. So here it is total gains, whatever we have gained. Okay, divided by the number of shares. Okay, on which the overall gain was there, and total what was loss. Okay, now it says that if RSI is greater than 70, it shows overbought situation. That is the security has moved too high too fastly. Okay, and if RSI is less than 30, it shows it has fallen quickly. Okay, now if we draw the diagram somewhat like this, this generally position indicates the bullish trend. Okay, and it is generally, if see, we can say that if it is moving like this, we say it is a bullish trend, and if it is falling like this, we say it is a bearish trend. Somewhat we can indicate it. It shows our RSI. It is also called the relative strength index. So it is generally used for the market to know the market trend, or we can say from particular security as well. One second. And there is another one theory is odd lot theory. Can anyone tell what is odd lot? Has anyone idea of odd lot? Can anyone give me the hint some what is odd lot theory? Or any what is odd lot if I say simply? Now today's you may not be aware about this odd lot because reason is being that now the everything has been dematerialized. Okay, that has been dematerialized. Now the securities can be purchased in form of even a one share, two share. But earlier there was a time when it was in a physical form. So generally there was a tradable lots. Okay, and these lots used to be in say 10, okay, 100, 50. Like these were used to be tradable lot. Okay, because generally what happens, physical script have to be transferred to the has been sent to the when so I am a buyer. Okay, I have bought some securities from say Mr. Y. Okay, now in that case, if I pay him and he delivers me the securities, I what I will have to do, I will have to get it sent to the registrar office, registrar of the company. Okay, there they will remove the name of that Mr. Y and they will enter my name in the register of members. So generally what used to happen, these are tradable lots are generally at a premium. Okay, generally because they generally are can be sold and purchased easily. Whereas odd lots, like somewhat we can say if 10 is tradable lot, so 1, 3, 7, these are odd lots. Okay, and generally they are at a discount because what used to happen, say I am a buyer. Okay, so what I used to do, I used to look for the persons who are the having a odd lots. Okay, odd lot means they have a 3, they have a 7, but tradable lot is 10. Now if this Mr. A, Mr. B are having these odd lots, they want to sell to the market, they will not get that much of say the if 10 tradable lot is trading at price of say 100, it will not traded at price of rupees 100 in those days. Now today they may have a same price, but in those days they will not cannot sell. So what they will do, they will have to send it some some say discount at say 90. Okay, so an investor, odd lot investor, what you as an odd lot investor, what I do, I purchase rupees 90, give 90, and I purchase it from the 90, and I combine these two lots and send to the registrar office where I get a one tradable lot of 10, which I can sell at a good premium. So by this, odd lot theory says that if from this odd lot dealing, we normally gauge the market. Okay, we normally gauge the market. It says that this theory used primarily to predict top in the bull market, but also predict reversal in the individual securities. Okay, when more and more people start buying the odd lots, okay, as it is a market is a play of demand and supply, more and more demand is coming for the odd lot. So it means the market is in bullish trend. Okay, so these are somewhat we can say odd lot theory is also used for market indicator. Now, students, so with this, we have discussed this some charts and market area. Now we are coming to the next part, that is decision using the data analysis. So somewhat we can say, as I told you, it is somewhat we can say uh, pattern analysis. Now, if I go back to my table, one second, just a second, I just, where is my table? One second, where is table gone? Yes. I think I've forgotten. Okay, no problem. The table is there. Now, when we talk about tools and indicators, okay, now let us discuss the tools and indicators. Okay, I will take it later on. No problem. Now, these are something tools and indicators. Okay, and generally these are some where we can say that these are some mathematical tools. Okay, so generally we use one is arithmetical moving average, another is exponential moving average. Okay, simple moving average I need not to tell you, because in that if there is a series, okay, then there what we do, we exclude the last item, include the latest item, and accordingly we start calculating the simple moving average. Then there is a exponential moving average. So when we talk about EMA, generally it is a kind of a series where, according to this, they say that we should give more weightage. The weight decreases exponentially. It means it says that highest weightage should be assigned to the latest prices. Okay, it says that, see, in generally in exponential moving average, all the prices generally have a same weightage. Okay, so generally to overcome this issue, this exponential moving average is used. Okay, and in this, what we do, we give the more weightage to this prices. Now, how we use it? The EMA is equal to be used like this formula. Okay, exponential exponent, or it is also called smoothing constant. Smoothing constant. It is also called multiplier. It is called by various names. Okay, so generally it is a number of trading days in our calculation, and is a number of trading days. Okay, here it is we multiply with the price of today. Okay, 1 minus this exponential and EMA of the previous day. Generally, this EMA of the previous day, when we take, it is very important. It is, if it is, say in the examination, it will be given the previous day EMA. If it is not given, if simple moving average of the previous day can also be considered. I will, when I will take up a question, because today's assignment, I will take up a question on the same, so it will be clear to you. Yes, Samantha? Okay.
Yes, sir.
Yeah, okay, okay. Now, when we say that, how it provides us a signal that what is the stock prices line rising through the moving average line when so all these are theoretical one. Generally what happens, I cannot say it is more as I told you, technical analysis more on our perception as well. So it says that stroke line rises through the moving average line when graph of the moving average line is flattening out. So generally these are some buying and selling signal. Okay, stock prices line file through the moving average line when the graph of the moving average line is a, so somewhat it we can say that it is like this. Okay, because it is actual price or it is somewhat moving average, or we can say that it somewhat look like this. Prices giving, and here the prices are going up, and it is actual prices also going up. Okay, stock prices fall below moving average, but which is rising. Okay, so there can be other possibilities as well. Okay, stock prices line are rising above the moving average line, which is falling. The stock prices fall above the moving average falls, but begins to rise after reaching the moving average line. So these are some interpretations. Just use it for the theoretical purpose, because if we go into the, because see in what happens when we draw out these charts, the common problem is that there is very minor variation in during due to the corrections, etc. So it is quite become difficult to interpret any price. So these are very minute things that is only chartists need to carry out. Now next, when we talk about evaluation of technical analysis, so just some are say that technical analysis are very important. And what are their arguments? Under the influence of crowd psychology, trend persists for the some time. Tools for technical analysis helps to identify these trends. So as I told you, it let us know when to invest. Okay, shift in demand and supply are gradual rather than instantaneous. Technical analysis will help in detecting the shift early. So it is the basics of the technical analysis. We have to identify the trend at an early stage. Fundamental information about a company observed and estimated by the market over a period of time. Hence, the price movement tend to continue more or less in the same direction till the fully information is fully assimilated in the stock price, and that is also called, if I recall our last class, it is called efficient market hypothesis. Okay, it is also called the, it is due to the impact of efficient market hypothesis. And in this case, when the market say it depends on at what speed it market reacts. So it is said that it is due to the EMH. Okay. Now detractor, some says ki this technical analysis have no use. Okay, because what are their argument? Most technical analysts are not able to offer a convincing explanation for the tools employed by them. As I told you, these tools are somewhat are very subjective. Okay, there is no sure shot any proof that this tool will work. Okay, sometimes they fail as well. Okay, empirical evidence in support of random walk hypothesis casts its shadow over the usefulness. Random walk theory we have discussed in the last class. Sometimes it may not work as we are planning. By the time uptrend down and trend may have signaled by technical analysis may have analysis, it may already have taken the places. By the time we notice it, action event may have taken place or market have corrected itself. Ultimately, technical must be defeated position proposition, with more and more people employing the value of such analysis trend to decline. As it is generally said, sir, and it is my disclaimer, please, this is topic for the theoretical purpose, because what happens when everyone start doing the technical analysis. So see, as I told you, the like in case of arbitrage, where we buy in a one market and sell in another market, if seller is such type of arbitrager are less, so more and more opportunities are there. But if everyone is sitting on a system, so the opportunities are very less. I just give you a very simple example. When in India jobs were more, okay, lesser people were applying there. Of course, the position was available for them. As more and more people are coming out uh, by taking the education, so jobs are limited, but more people are there. So of course, at this time, the competition will be tough. So it is somewhat like this. Okay, I think student, this with this we have come to this topic, theoretical topic. Now, what I do now, there was one second. There was an equity research tools available that briefly I discussed. 1 second. So we have discussed these fundamental changes in the difference between the fundamental and one or more difference. We can see that. 1 second. Now, when we talk about these differences, somewhat there are some more differences I can also discuss with you. Just like, okay, these are for your, okay, these are we have discussed like methods, rules, and usefulness. Okay, now there in addition to that, there are some more differences like source of information. Okay, generally in this we use the information of industry like and a company, annual report, etc. And in this we also use information like industrial data, GDP data. Okay, and in the technical analysis we use the information relating to market prices. Okay, so in technical analysis the information is internal. Okay, in fundamental analysis it is external to the market. Okay, similarly the objective and objective is clear. I think it is more clear to 1 second. The objective is fundamental is basically concerned with the intrinsic value to find out the intrinsic value. Technical analysis is concerned with the reversal trend, analyze the trend and its reversal. It is the main. Okay. And very important, emphasize in fundamental analysis, prices based on performance of company and market forces. And in a technical analysis, it is based on forces of demand and supply. Okay, so basically fundamental is concerned with the performance of a company and it is concerned. Okay, so these were some more differences. And then we come to the next step. Efficient market we have discussed in the last class. Okay, then there were some researchers have concluded, now these are this all theoretical are available, that they are saying that this is not market does not react what we think that, because these theories are not that we can say they are more strongly recommend the randomness in the market. Okay, because and the was a result that lead to this available and all participants keen competition among the market participants more or less ensure that the market reflect. So basically they say that it is a fundamental value or fundamental analysis that pays. If the company is strong, so nobody is going to buy the demand and supply and superfluous. Okay, the price changes response to new information that is unrelated to previous information, that is therefore unpredictable. Sometimes what happens, generally any new information comes, so it generally ignores the previous information. So it is very important that they don't, because sometimes it is said that, and I will not take the name, but sometimes what happens, a person may be getting some, there are good news are coming about any company's head. Okay, that this company's head is getting this much of award, this much of award. But suppose if any adverse news regarding this head of this company comes, okay, so then in that case what happens, ultimately the market ignores the previous contribution of this person, etc. Now they go for the latest one, and accordingly market react. Okay, and there is about the misconception about the market efficiency. All these are theoretical topics, so you discuss from there. Now, so that we come to the last part of this theory. Then these are all levels, that is weak form, strong is strong, as I discussed with you in the last class. Now these are some empirical tests. Okay, empirical test, and three type of tests have been employed empirically to find them. And these are, for this, we shall take up the numerical for the serial correlation test. Okay, so there is one question for the serial correlation test. Then there is a theory of the run test. See, in a run test and filter rule test, I discussed with you. Okay, so let us discuss what is this. For this, I will take up a numerical. Okay, basically it is relating to some, we can say that we analyze, or I just discuss with you, then it will be clear. Okay, I start discussing, then I will take up a practical. Now first I take serial correlation test, or it is also called. Okay, in this, the prices of stock is compared for a particular number of days. For particular number of days in two periods, corresponding period. Okay, say we are taking the 30 days. So first 15 days, then another 15 days. Okay, we compare their prices. Okay, we just put a column wise there and we analyze the change. Okay, if correlation is near zero or near to zero, so no, we can say that uh, prices change are independent of each other. Okay, and if it is somewhat say near, it is said prices change are very near to each other, very closely related to each other. So it is somewhat called, when we shall take up the numerical topic, it will be more clear to you. Now then there is a run test. For this, we shall also take up a practical. Now here in this, say, in the very simple logic, in run test, what we do, we go by their sign change. Say prices is falling down, so it we say minus minus. If it increase, more increase, plus plus minus. So what we do, we carry out the analysis of this sign changes. This is called run test. Okay. So generally what happens, if the sample size is less than, more than say 30, okay, 30 is, it is somewhere 30 sample size is there. So we use the Z test. If the sample size is less than 30, we use the T distribution. Okay, where we use the test of significance. Okay, that is a today's numerical. So these are two or three numericals are there. Then there is a filter test rule.
Sir, could you please repeat what is the 30 numbers? What will you do?
But we, see, basically what we do, we take the sample. Okay, we take the sample prices or whatever we are doing the analysis of prices. Somewhere we are analyzing the closing prices, okay, of particular security. Okay, so now suppose if the prices are falling down, we write like this. Okay, now see if our prices are number of prices. Okay, number of prices means item of our analysis sample size is more than 30. So we use the Z test. Okay, generally it is used in where, if you recall that. Or if it is generally less than 30, we use the T distribution. Okay, this question is in your study material as well. Okay, now what happened is, see, this question is basically a very old question. Now, of course, we can go for a jet test as well, but our course will be on a higher side since there is one question in your study material that is related to your T. Because if you see the question, assignment question, just you bring out the assignment. If the assignment is with you, uh, 1 second. Now, if you see the assignment, question number 4, okay, there the prices have been given to you. Okay, and I think this prices number R is not going more than 30. So we shall use this test, T distribution test. Okay, Samanathan, clear to you?
Yes, sir. When we are comparing the price more than 30, then we will use Z. Otherwise, we will do the T distribution testing.
Distribution. See, Z test also we can do, but it will involve a lot of calculation, and on a simple calculator, it becomes a difficult, somewhat, very difficult. In a exam, it will create a very huge problem. Okay.
Okay, sir.
So, okay, now, and then it is a filter rule test, and a filter test generally say that if just explain by way of one line. Somewhat it says that very simple, and it is generally based on about some calculations maybe based. Generally, it says that trend reversal. Okay, somewhat we do a filter level we fix up. Okay, say of 2%. Okay, and generally prices are analyzed. Okay, generally prices are analyzed. Okay, now if the prices goes above say 2%, say above is going over 2%. So ultimately we know that it somewhere moves between 2% to down or upward. But when it start upwards going up, so we say that it is somewhat moving in a random manner. Okay, it is somewhat moving in a random manner because there is no such any information in the market due to which it is moving up. Similarly, it is going down, so it is somewhat indicate that the prices is moving in. So somewhat it will fix up a line. Okay, this price of the security will move in this range, always somewhat 2% something. So by this we come to know this. So student, and there was one last from my side is empirical. This is 1 second. Okay, then these are theoretical challenges are this. Then there is the some equity research tools are available. So generally some list have been given to you in the study material. You can refer from the same. So generally in the exam such only one or two small question can be asked from it because there is no such, because this data keep on changing. So just this is for your knowledge only. And my request to you, please don't indulge yourself in that trading. So now with this we have come to a close on of the part of theoretical part. Now after we are taking a very small break, say about 10 minutes only. After 10 minutes exactly, I will come and I will discuss with you the final part of our this class, that is assignment. So I will take up the assignment after post break. So meanwhile we will go take a small break. So see you after the break. Ashok ji, thank you. supplied to you already. So you can see here this is question number 1, and basically I will discuss with you the point and figure chart. Of course, the point and figure chart have been given in the study material. It is not correct. So here I will discuss with you the corrected version. So now the period is here given to you, and here the corresponding prices is given to you. So first, second, third, fourth, fifth, sixth, seven, eight. So these are 10 days have been given to you accordingly corresponding. Say any closing price or whatever we can say, we can use here. Or generally what happens, it can even we can say it even sometime even in a single day it also measures the changes also. Okay, so now when we start with the 48, this can be either given as a arrow or it can be circle, darkened circle. Now prices have moved from 48 to 52. So what we do, we will not change the day, we will not change the column, rather we will move in a same direction up to 50. So we put two crosses over there. Now again prices have moved from 52 to 54. We put more cross here. Now 50 from 54, the price have gone down to 52. Okay, so what we do, we put 0 here and 0 here. Okay, because as I told you, the increase is shown by way of cross, whereas the price fall is indicated by 0 or O. Now here the price again have increased from 52 to 56. So again we start putting the crosses this way. Okay, now here the price have fallen down from 56 to 54. So from 54 to 50, so this we put 0, 0. Now again price have gone from 54 to 52. We put sorry, I will just stop my here. Okay, so my price have gone from 54 to, so this from 52 to 52. Now again this price have gone to 50. So we put one more 0. Now again price have gone up from 50 to 52. So accordingly what I do, I put cross like this. Again, my price have gone from 52 to 46. Okay, so what I do, okay, student. So by this, we can somewhat analyze the market trend. What is all about market trend? Say initially, we can say that prices were somewhat have gone little bit up, but it start downward. Okay, again it has gone, then it has start falling. So somewhat it indicates the bearish phase. Okay, so we can analyze by this how the prices are behaving. So it was a simple example of point and figure chart. Now let us discuss the next numerical. Okay, it says like this: the closing values of BSE Sensex from 6th to 7th of the month of January or the 2000 to 200x were as follows. So these were the days, these were the dates. Okay, this is a Sensex have been given. Okay, now you have to calculate the exponential moving average of the Sensex during the above period. the previous day exponential moving average of the Sensex can be assumed to be 15,000. So it means day one before this EMA was 15,000. Okay, the value of exponent for 31 days is 0.62. Now this is exponential component, or we can say smoothing constant. Okay, it is computed by say 2 divided by 31 plus 2. Okay, just calculate it. So somewhat it comes 0.625. Okay, now since it has been given 0.62, so we shall use only this value. Sometime it may be possible that this value may not be given to you in the question. Okay, but if the number of days of smoothing constant exponent period have been given to you, for how many days you have to calculate, then you will calculate it at yourself. So it may be even used for 30 days. Okay, in this case, it will be 65 something or 645. So you have to calculate it at your own. Okay, it is coming somewhere 0645. Okay, you can use this 64 or 65, whatever use, no problem. Okay, up to 4 decimal point, you can 3 decimal point, you can use it. Okay, so don't worry about the rounding off. We will consider in that case 3 to even 4 decimal point, we can consider these values. But unless and until some rounding of instruction have been given to you in the question. Now here it says you have to calculate. So give your detailed analysis on the based on your calculation. So now let us start solving the question. Okay. Now, first of all, we draw out a table containing the 6 columns. Okay, it is date. It is Sensex. Okay, EMA for previous day. Okay, now say it is column number 1, say 1, it is 2. So 3 will be equal to 1 minus 2, 4, 3 into 0.062, and fifth is EMA. It will be 2 plus minus 4, whatever we result. Okay, now let us start with the first day, that is 6 Jan. Okay, okay, now census 6 14 50,522. Previous day have been given to us. Okay, 15,000. So what we do, we deducted here. The value comes negative 478. We multiply this value with 0.62. This value comes okay. So what we do from this value, okay, from this value previous day, we add up or minus this value. Okay, 15,000 minus this, the figure comes 14,970.364. Now, students, sometimes it says that, sir, you are using up to 3 decimal point. If we use 4 decimal point or 2 decimal point, student, don't worry about the same, because I think similar type of a question has come into the May 2024 examination, where we have considered alternative solution for 2, 3, 4 for all possible solutions. So don't worry about this part. Okay, don't take the tension of this. Unless and until if some instruction have been given in the question, then follow it religiously. Then if you attempt the question by defining the as this note, then of course you will lose the marks. Then on the seventh day, my Sensex is 14,925. Now here, previous day EMA will be this value. So this value will be come here. Okay, I take out the difference. It comes 45.364. Multiply with this value. Okay, then adjust it from this value. Okay, I think there is some difference in the value. Well, let me check. 140, 1497.364 minus 2.812. Okay, somewhat it come 2. Okay. Now we are coming to 8th. Okay, this value, we deduct it from this value minus. So it comes 254,448. Okay, so from this value, we deduct this value. It comes 14,983. We add, I think it will be added. 1 second. Yeah, it will be added. Okay, it will be added because it is a positive sign. Here it is positive sign. And accordingly, value will be added. So it comes 327 or 328 somewhat. Okay, 9th day it is coming. Sorry, 6, 7. It is 10. Okay, it is 11. My mistake. Here it is coming 16,000, 14,983.328. Okay, minus plus. Okay, this will be multiply with the 1016.672 into 0.062. It comes 63.034. Okay, we add up this value. Okay, the resultant figure comes
15,046.362.
354 or 3 something like is coming. Let me check. 362 or it is coming.
3616.
1498 3.328 plus 63.034. Yes, you are right. 362. Okay. Samathan, it is correct now?
Yes, sir.
Okay. Now we are taking next value 12. It is somewhat coming 16,400, 15,046.354. Sorry, 362. Okay. Now here the value comes 1 minus 2. It comes 16,040. 38. Okay, we multiply it with 0.062. One second. Just write it. If I am going wrong on any track, so please correct me. 46.362.
It's coming 15,130.287. 288.
Yes, 288. Yes, you are correct. 288. And coming to 13. 13 day, it is 17,000. Okay, it is coming 15,130.288. Okay, and it is coming 169. 1869.712. Okay, now I multiply with the 062, it comes 115.922. Okay, plus 1530.288. Is it correct? 18,000. Two seven 53.78. Nine zero. Okay, student, it is a correct calculation now.
Yes, sir. It's right, sir.
Okay, so we can see that the market is bullish because initially it had slightly moved down, but after that it is exponential moving average is rising steadily. Okay, so we can say that market is bullish because it is relating to the Sensex. So we shall see, we write here market will, and if it remains like it, we can say that if the factors, we can say if it will remain, it remains same, it remains same in short run and medium run if the related factors remain the same. One second. Okay, so that we can take a long position in the Nifty or Sensex. Okay. Now we are coming to the question number 3. It is one of the questions that has been come in the earlier examination, and since it is basically concerned with the we have to test the weak form of market efficiency using the autocorrelation or serial correlation test. Okay, taking the time lag of 10 days. Okay, so as it indicates the lag, it means that that's why it is also called autocorrelation test. It uses a lag of say any period, and accordingly they take the same period, two different periods. They take the two different times, but the same period. So accordingly, we shall compare, carry out the calculation for first 10 days, then after these 10 days. So we shall find out the relationship between these two prices. Okay, between these two prices, we shall find out the changes. Okay, now let us see the how we solve the question. So basically, it is a kind of a long calculation. Let us start quickly doing the same. In this calculation, I have rounded off the calculation to 2 decimal point. Okay, now here we take the period 1, and here we take the period 2. Correspondingly, the closing prices we shall analyze that is then given to us, and then we shall discuss the change. So both way we shall use the closing prices. Okay, then we shall take the change. Okay, now the first prices is this price and this price. Okay, so we write it here. Period 1, 33, 453.99, 33,251.53. Okay, now we are just changing here. It is again 11. Okay, 10 days difference. Okay, lag is of 10 days. Here it is 11, it is 1. Okay, here it is period 2. Okay, lag is of 12. This. Okay, so I just go for the change for the same. The price is changed. Okay, it has been reduced. Here it has been increased. Now there is an increase. So it is here positive 34.36. Again lag. Fifth. But it is 30 point. This it is 16 days lag. Here it is again 33,325. Student, in this type of a question, please always remember, whenever you take up the figures, please take the correct figures from the question paper. Because even if a slight mistake will completely make the wrong your answer. In this type of a question, lot of precaution is required. Of course, in a time examination, the time is quite stressful, but my request to you, please be careful in taking this figure. Once these figures are correct, these two figures are very important to correctly note down. Because once these figures are correct, and then ultimately calculation will be very easy for you, then there are chances at least of wrong calculation. In most of the examiners comments, they say the student have committed a mistake in this answer. Okay, then it is 335.08, 4.10, 18, 33.19.67. Okay, now last lagging period 10. Okay, now these are our changes figures. Okay, these are our changes figures. So accordingly, what we do, we make this figure as variable y x, and we take this as a variable y. We take it as a x, we take it as a y. So we divide it into, we as it is reproduce this figure in a new table. Okay, now let us draw out a table quickly. Now here we shall start our computation. Five column table will be required.
Sir, only two period to be considered, or even more than two also can we consider?
Decimal points. When two means
See, here we are dividing into 10 packet, two
yeah.
period one. Is
No,
that
only two
possible?
periods. Always compare two periods only.
Okay.
Only compare two periods. Okay, now we take the value x and here as a y. We make a square of x, we make a square of y, then we multiply with this. So quickly I start writing the values. So see if these values are correct, very important in a first table is very important for us. The later part is quite very simple. Sigma x, we add up the same, minus 194.96. Okay, x bar becomes, we divided by the number, our observation, it is number 9. 1, 2, 3, 4, 5, 6, 7, 8, 9. It is very important. Okay, generally student commit a mistake here. They divide it by the 10. No, we have to divide it by the 8, 9. Okay, because changes number of changes is 9. Okay, sigma y is 68.08. So sigma bar is 7.56. Okay, we make a square. Okay, we make a square of the same. Quickly, the figure comes. Sigma x square is equal to this 707.56, 20.88. Very simple. We have squared off all the same and we have taken their sum. It comes 6745.74. All these are calculations simply. Now what we do, we multiply this both values. Okay, now here the result say here it is very important to keep in mind the the sign. Sign is very important here in this column. Okay, because we have to see because if the any even a single sign is missed out, then our complete answer will be wrong. Okay. So now we come to we will find some values. Okay, because we need some equation. Okay, we need some equation because we will determine the coefficient of determination. Okay, from this coefficient of determination, basically I tell you what we use. See, we have to compute this value r square. Okay, and for this r square, what we need sigma a into sigma y plus beta b into sigma xy minus n, that is number of observation, this divided by, okay, now this is called coefficient of determination. Okay, when we shall use square root of r square, it will come the coefficient of correlation. So we have to find out these values. Before that, we have to find these two variables, values of these two variables, and value of this b is equal to, what I write on a next slide page, sigma xy minus n, okay, sigma x square. Accordingly, we compute the values. Okay, so this computation comes 0.624. Similarly, we compute the value of a. A will be y bar minus b into x bar. Accordingly, it comes 7.56 minus 0.624, that is same value, into minus 21.66. The figure comes 21.08. Okay, now I start placing these values. Okay, so the r square value comes 0.164, and if it becomes r becomes, so see, as I told you, if it is somewhere near about, so there is no correlation, etc. But here it is somewhere 0.405. So there means there is a little bit a moderate degree of correlation. Which shows there is this shows that no weak form of market efficiency. Now, if here, it is very important to note, if this value somewhere come around zero, it indicates that there is a weak form of market efficiency exists, because market does not move in a any particular trend. They move in a random manner. Because if the market move in a random manner, then this value will be somewhere around near zero. Okay, student. So with this, we have come to the end of this as a third question of this. Now we are coming to quickly to the question number 4 of this is basically on a run test. Now in this, it is also based on our calculations. Okay, now here very important to note that here we have to pay attention to the change of the sign. Okay, so now number of runs means how many times. Just see here the closing value of the Sensex for the April October 2007 has been given to us. Okay, this is we have to test the weak form of market efficiency by applying the run test at 5% and 10% level of significance. Following values can be used. So this value will be given to us in the examination. So don't worry about these values. Okay, now here we have to very important. We have to pay the number of runs. So first of all, we have to compute number of runs. So closing price. Now I quickly write the prices. Or what can I do? I just draw out a one column in between. It will save our time.
So number of runs only the trading day. We need
Not
not
trading. No, not trading day. You will see. I'm just showing you. It will show the change of sign.
Okay.
Okay, change of sign. So here from 2870, the price has down. Okay. So what I do, it is a negative. Okay, it is negative. Okay, now again the prices is now here it is price have increased, so it becomes positive. Okay, again price have rising, it is become positive. Again price have gone down, here it is negative. Okay, now price here again have increased, so we take it as a positive. Is it clear now?
Yes, sir.
Okay, it is again positive. It is again positive, 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 positive. Now here it is declined. So what we do, we put a minus sign here. Again declining, but here it is rising. Okay, now again declining, again declining, again declining, again declining. Here it is positive. Okay, so first of all, we have to count the number of runs. Okay, when we count the number of runs, so let us start counting the number of runs. First run will be this. Second run will be this. Okay, because from -2 plus, then here -2 plus plus to minus, it is third run. Okay, then it is -2 plus fourth run. Now here there will be no run. Okay, there will be no change because here it is plus plus plus. Now when it will change, this is another. Then we will ignore this one. Okay. Then from minus to this, here minus minus minus, no change. Then here it will be run. Okay. So the total number of price changes, we can say it is a kind of a price changes 1, 2, 3, 4, 5, 6, 7, 8. So one second.
Which means the totally 8 run.
We can say that 8 runs, we can say that because number of changes are 8. Okay, sign changes are 8. Yes, you can say that. Okay, so now it is somewhat total price.
So the one question is that trade closing is 110. After that, it's 310 is coming, which means in between second is holiday on non-trading day, right?
This is first now.
Mm.
First we can say 0. You can say it is a just we are assuming. Okay.
Which means
Before that we have to start like this.
no, my question is the date closing is first mentioned the first is October. The second date is mentioned 3rd October, which means in between the second is holiday or no trading day.
Holiday. We have to take on which the trading is takes place.
We should not consider the in between that.
Never. but where the opening market are there, that is more important, because only that will let you know the sentiments, na. It is all in use in your technical analysis. We never ignore the closing days. But the closing means in the day where there is no trading.
Okay, sir. In between, more than 1 day is also there, right?
Yeah, yeah, somewhere. So it is R number 8. Okay. Now number of positive signs. Okay. Now let us count the number of positive signs. Okay. So it is coming number of positive signs or number of positive changes. It is N1. It is coming 11. Number of negative signs N2. It is coming 8. Okay. We compute the value of this value 2N1 and 2 divided by N1 plus N2 plus 1. Somewhat we can say it is kind of a mean value. Okay, this value comes 10.26. Okay, now we will compute. No, just draw to comply. Now we shall compute somewhat the standard deviation.
Sir, why we are using 2 in the numerator?
2 in the, let's say, I cannot say on the same because it is a somewhat calculation method. We cannot go that much detail. Okay, it is a formula. Because if we start doing all this now, then there will be beyond the scope of us. But just we have to, and I think if you ask me, only 4 to 5 formulas like this. One of these formulas also as well this. Other formulas, there's not that much of formulas in AFM. Generally, it is said there are too many formulas. Generally, all like black schools that we will discuss in that is black schools model, that is in derivative topic, minimum portfolio combination. There is one other formula, and there is one or two formula more are there that you have to remember. But somewhat if you find that we can discuss somewhere, if the time will permit, I will look up for the whatever computation basis, because these are some on based on research papers, more or less they are based on research paper, and we can say it is simplified version. If we go by their uh, other version, they are quite bit or more complex. Okay, now we shall test its significance. Okay, for this value have been given to us 5% and 10% at 18 degree of freedom. Okay, this is T table. Simply 10.26. Sorry, this was a lower limit. Okay, now we will calculate upper limit. We will add up the same. Okay, now we also test the same at 10% level of significance. Eighteen degrees of freedom. This is lower limit. Okay, now if we analyze the R value, okay, this run test is R value. Okay, this run test is R value. Okay, these run tests are somewhat lying between these two values, 8 here, okay, and here it is also somewhere lying I value 8. So we can conclude that when this value is lying somewhere in between these two values, so it means that they shows the weak form of market efficiency. Okay, if it is above it or below it, we shall say the weak form of efficiency market does not exist. But here it is lying somewhere in between these two values. So it means the weak form of market exhibits. So simple, it was a very question. It was just only involving the calculation and one formula. So student, now we are just before we end up our session, this case scenarios from the case booklet of your has been available in your study. It is available on website as well as you can purchase it from our CDS portal. So just I am discussing with you case scenario so that this concept, the topic is clear to you, and some MCQs are also discussed as well. Now you start just reading the case scenario, then we will discuss their MCQs. Now it says that you, as a financial analyst of a prominent investment firm, and have tasked to empirically verifying the weak form of market efficient market hypothesis theory for XYZ stock index, a collection of diverse stocks. You have decided to conduct three different tests to assess whether the stock market follows the principle of weak form of EMH. Okay, test one. You have calculated the 5-year data daily price change of the stock in the XYZ stock. You calculated correlation coefficient for the different lag period and analyze whether the past prices change exhibit any significant correlation future price change. You considered price changes to be serially independent. The result indicated that most autocorrelation efficiencies are close to zero and statistically insignificant, suggesting that those prices does not predict the future changes. Test 2. You investigated the randomness of the price changes of the stock index, analyzing the sequence of daily price change. Okay, you count the number of runs when the price changes are constantly positive and negative. You observe upon comparing the observed number of runs, you is expected number of random, you find that they are aligned closely, supporting that the idea that price change follow a random pattern. Now test 3. To examine the efficacy of the trading strategy based on historical price trend, you implemented a single trading rule for XYZ stock index. The rule involves that buying when the price crosses a moving average of say 5% threshold, selling when it crosses another 7% threshold. Over a period of testing, you computed that return generated by trading this strategy. The strategy result revealed that the returns are not consistently better than random chance, implying that price do not indicate the future price movement. So all this is test we have applied. Okay, and ultimately coming there like that, somewhat we can say that we cannot predict the trend. Okay, rather it is indicating to somewhat randomness. Okay, after conducting the three tests, the evidences support the weak form of market efficiency theory. Whereas you concluded that the price trend do not rely on the future price. From this, we have to correct the answer. Choose the correct answer. Test one is now it is you please tell me which answer is correct. Now in today's class and even last class, we have discussed all these tests and especially in today's class. So you can easily answer the same.
One A.
Yes, very good.
Yeah, it's a correlation test, serial correlation.
First, na?
Yeah, first A.
Second,
Second, I feel more run test.
yes, because
Run
it has been
test.
mentioned. Okay, third, we are using some threshold.
The threshold means filter test. We will use
Yes,
filter, no?
yes, yes,
Yeah,
filter.
yeah.
We are applying the filter. Very good. Now this is some, but relating to your theory, if you will read the theory, you can answer this. The filter rule should not be applied for buying or hold study. Very, otherwise very simple. Even you can simply you can try it, even if you are not referred the study material, because it is based on some common logic. In the given case scenario,
I think maybe option C.
no, here filter should not be applied for buy and hold
The
strategy.
behavior of the stock price changes is random.
Yes. You are correct. You are correct. What is your name? I know the Samanathan. What is your name?
Sanjay.
Sanjay. Okay. Yeah, very good. Now last is result of your studies support the
So which results are we talking about?
no, what we have concluded here, no? That's the overall conclusion. It is saying, no? Results of your studies.
Of all the tests.
Of all the tests, whatever we are doing, if we go by the and even conclusion, what conclusion says? We are
Is it option D, sir?
no, not option D.
Is
Very
it
far off.
random
It is
walk
related to
theory?
portfolio theory.
Random walk theory?
Yes, random walk theory, because if you see, remember that during my discussion, I am using the word random walk as well when I was using the weak form.
Okay, random walk theory. Okay,
Yes,
sir.
because whenever we use the weak form, it says that market does not behave in a discount does not discount all the information. The discount is very later. So in between the prices move very randomly.
Yeah, I am very strong that the semi-strong and the strong is not there, but I am confusing between C and D.
Yeah. Okay. So is it clear to everyone now?
Yes, clear.
Yes,
Okay,
sir. Very
thank you.
much clear.
Okay, student. So with this, we come to the end of the chapter number 4 of our study material. So first we have completed theoretical topics like financial policy and corporate strategy, then risk management, then third is advanced capital budgeting. Now this is we have started with the fourth chapter. Now if we start this topic is the first topic, that is our section 2, which is security oriented section. Okay, which is a security oriented section, because after that we shall discuss the topic of security valuation, and after that we shall take up the topic of portfolio management. So with this, there's another. So we can say that we have completed first part of our section 2. So student, as I usual, if you have any query, you can contact me over that telephone number, the same. Okay, or you can write us at email. Of course, you can also send your mobile app as well your queries. More frankly, if you can contact me personally, it will be better, because sometimes what you want to write, I could not, you may not convey in the same manner, but whatever or what on these lines, what you want to say. And even sometimes I also feel a problem. Generally, I prefer we can have some telephonic conversation on the same.
Right, sir. So in assignment, there is one more question, sir. Is there?
There is one question. Let me check. I forgot. No, assignment. I have completed, I think, all the questions, or one more question. Which question, beta?
Last question, I believe.
Maybe I think it must have come wrongly. What is starting with is a question. Let me
One minute. Yeah,
let me check.
let me check on that.
Yeah, no. Oh, I also check at my end. Let me check better. If there is any question, I have to do it. 1 second, 1 second. Let me check. Uh, what is coming? Let me check better.
Sir, it is no, sir. I looked at that in other things.
Okay. So overall completion, na?
Yeah.
Okay. Okay, student. Thank you for patience listening for today's session, and we shall start with the security evaluation in the next class. So if you have any query, you can share with me. Okay. So now let us come to the end of this. Let me come to the end of where I have written my phone number, etc. Okay, student.
Yeah,
Okay.
sir. One of the question in the study module. So I thought that we are including in this.
Which
Right.
question? In the study material, I think I have covered all the questions. Let me check. If the same question will be there, just let me check. If you have pointed out, let me. Hmm. No, student, I think I have completed all the questions. In the study material, there are 2 questions only. Or 3 questions. I don't remember. Third question is what says it says. I have an old edition with me right now. Let me check. In the study material, additional question is there.
Sir, I think I referred somewhere in RTP or
No. In not study
MTP.
material, there is no more question. Okay.
Okay, right, sir.
Okay.
I was under the assumption that it is there in the study
No.
material.
Because I'm
Right,
sure, bit sure. Okay. Okay,
right, sir. Thank
student.
you, sir.
Thank you. Have a nice day. See you in the next class.
Thank you,
Thank you.
sir.
Thank you, Sanjay. Thank you.
Thank you so much, sir.
Thank you. Okay, Shubh.